Hi, everyone. My name's Jared Levy. I wanted to welcome all of you to Westwood's new Outlook and Strategy series. Here we highlight different market segments and discuss market climate, strategy, and how investors can best position themselves in each respective asset class, and how to generate alpha, reduce risk and volatility, and obviously protect the downside. Today's roundtable is going to be highlighting and focused on the small cap space and obviously how it's being impacted by the current events, COVID-19, as well as Westwood's small cap team strategy during these times and how their active thinking and process for evaluating companies may play a key role for investors and allocators alike. If you're unfamiliar with Westwood, the firm has always taken an active approach to investing at the intersection of quality and value. A little bit different twist there. We'll discuss that more in detail as we go forward today. With me, I've got Westwood's head of intermediary distribution, Harvey Steele, product head, CFA Phil DeSantis, and co-director and equity portfolios and small cap value portfolio manager, Mr. Bill Costello, joining us via satellite phone. Gentlemen, going. So, Harvey, I want to start with you, and I'm reading the quote here. Economist Mohammed El-Arian recently cautioned investors should be buying individual stocks, not indexes, because more coronavirus-driven market volatility is likely coming. Obviously, I think most of us agree with that. I want you, if you could, drill down on that logic a little bit and specifically how it plays into the small cap space, because I think there's some nuances here when it comes to small caps as opposed to the broad market.
Well, first, I absolutely agree with Mohammed here. But as it pertains to small cap stocks, there are many, many more reasons than just COVID-19. For example, financial advisors all over the world have been heavily allocating to small cap growth stocks over small cap value stocks for the past decade or so. And to be honest, it's worked. I mean, the return differential has been staggering. Over the last decade alone, the small growth index has delivered 74% more cumulative return through the end of March than the value index has. And that's even with the sell-off. It's given you more than double the cumulative return. Moving forward, though, I think this is going to be extremely hard to repeat. And I'd like to hit a couple of reasons why that might be. First, even if you look at post sell-off, so end of the quarter numbers, the small cap growth index is trading at over 134% of its historic valuations when looking at PE, compared to 73% roughly for the small cap value index. In fact, this is the most expensive that growth has been in small cap stocks relative to value in many, many years. This is almost a 2 standard deviation event. Second, if you look at what's been driving the bulk of the returns in the small cap growth asset class, there's a trend that's been established that might not be sustainable moving forward. And what that trend is specifically is the potential to really outsource R&D for tech and healthcare companies. A good number of these firms are being venture capital backed or private equity backed, and they're really being funded with no immediate plan for earnings, no immediate plan for operating income or generating free cash flow. They've essentially been funded with the idea that there could be a potential buyout in the future. And that's driven a ton of returns. It's worked really well for people. But if you think about the environment that works well in, you have to have a growing economy. You have to be able to highly leverage your balance sheet. You have to have easy credit. You have to have low credit spreads, and you have to have real GDP growth. Now we have spreads that have blown out, GDP in decline, and credit's really tight. That model changes, and it gets really tough. And I think for that reason, in many ways, one could say that big parts of the small growth index is actually broken today.
So obviously, we're not saying that every small cap growth stock is broken, right? I mean, I think what you're saying here is the weight, the majority of these companies, sort of depending upon those models, is putting a major strain or going to put a major strain. Obviously, it has on small growth stocks moving forward. So then, do you pivot here to small cap value? Is that a solution?
Well, honestly, Jared, if you look at it on the other end of the spectrum, you could make a similar argument that a lot of the constituents of the small value benchmark are broken too. I mean, look, let's take a look at the numbers. If you look at the index broadly, roughly 40% of small value names have no earnings. And that was in Q4. You look at where we've come over the last 3 months, and I think that conservative estimates are somewhere between 60 and 80% is what we'll see for Q1. And for the whole year, greater than half of small cap value names are considered to have no earnings. Second, you start to look at the benchmark in aggregate, and it generates almost no positive free cash flow. Again, these were year-end numbers. They're going to be much, much lower now. And third, and I think this is probably the biggest point, is many of these businesses are fundamental deep value kind of turnaround stories that are predicated on some intrinsic value of a capital asset. And you get this scenario where you have these value traps and they look really cheap at price to book, but it's not really what you would want to invest in if you're looking for a quality driven recovery, which many folks are. So I think in this environment, advisors absolutely need to look at how they allocate across the small cap landscape. And I think they need to hire active managers to find the companies that are going to make it through. If you're indexing, whether it's growth or value, I think you're going to be disappointed moving forward.
Phil, let me bring you in here for a second. You recently wrote a paper back in the fourth quarter calling attention to investors on how it was critical to get something you called a twist, right, when it comes to small cap value. You said two of the biggest problems going into this downturn were leverage and misperceptions around traditional value investing. Can you elaborate on this point for our viewers?
Sure. There's two things that I wanted to accomplish with this paper. First and foremost, we wanted to point out to investors that there's a difference between investing in high quality small cap companies and traditional value investings. But the other thing I wanted to call out for investors is what I consider a pretty big miss for many investors that were making that shift from growth to value with the intention of performing better on the downside during an economic downturn or during the latter stages of an economic cycle. And I think the big miss in my mind is that it's not that easy. It doesn't work like that. Just buying companies that are trading at low PE ratios, buying companies that are cheap from a price to book standpoint, doesn't necessarily guarantee you that consistency over multiple market periods and doing better in economic downturns. I think we saw that play out with COVID-19 in March.
So Phil, detail this big miss a little bit more for us, please.
Sure. So let's take a look at the last 3 times we've had an inverted yield curve. And that typically when you have an inverted yield curve, you have periods of economic distress and you're seeing a downturn in the equity market. If you look at traditional PE ratios or traditional valuations with low PEs, what you'll see is, and it's pretty surprising, if you just went out and bought cheap companies from a PE standpoint, these companies in and by themselves significantly underperform the market to the tune of 500 basis points to nearly 1,500 basis points below the benchmark. If you looked at companies that had low price to book ratios, again, just in and by itself, those companies did okay. They slightly outperformed the benchmark. I think that's the misperception we're trying to point out for investors. Now, if you shift the quality and you look at free cash flow generation, the true economic profits of a company, this factor did extraordinarily well in periods of economic distress and significantly outperformed the market, somewhere between 500 basis points and nearly 2,000 basis points, depending on the time period that you looked at. If you looked at return on equity, companies that had strong return on equity, another important quality attribute, these companies outperformed the market. If you look at companies that were highly indebted or had leveraged balance sheets, these companies underperformed the market. So the key takeaway here that we want to point out is just buying cheap companies, just buying companies that have low PE ratios or low price to book ratios doesn't necessarily guarantee that downside. You have to get the quality aspect right. Companies that have strong free cash flow, strong balance sheets, strong management teams, and typically have some type of competitive moat or industry advantage in the respective sector they're competing in, to really check that quality box to get that downside right when you're shifting from growth to value.
How does Westwood then approach this, as value investors? I mean, you mentioned sort of a lot of different variables there, right? I mean, what's Westwood's approach here, and how do they get it right?
Sure. Within our Westwood small cap value strategy, our focus philosophically is investing that intersection between quality and value. So we have, of course, we want to buy companies that are trading at, obviously an attractive valuation level compared to what we think their intrinsic value is, but we have to get the quality aspects right. Again, as I mentioned prior, companies that have the right capital structure, companies that have low leverage, typically have less leverage on their balance sheet, strong management teams. It's important that we're getting both the valuation characteristics right and the quality characteristics right to make that decision to invest in a company.
When we come out of this, okay, when the world returns to normalcy, obviously we don't know what that's going to look like, nor do we have a timeline. If Westwood gets it right, what does that look like? What's it going to look like for investors in small cap? What do you think it could look like? Obviously, this is hypothetical, but what are some of your opinions on outlook, moving forward?
Sure, it's a great question. I think when you look at the starting point from where we're at today with the recession, this recession we're about to go into is very different than many other recessions, where our starting point for many of these companies in the small cap asset class is one where the level of leverage that we're seeing, Harvey alluded to this before, is much higher today than what we've seen in past recessions. So I'm going to go out on a limb here and say that when you think about potentially 20 to 30% of the index going bankrupt, or at least having to restructure, 2/3 of the index possibly being unprofitable this year, I believe you're going to see quality lead out of this when we do hit the bottom, when we do rally out of this. And I think historically what you've seen with the way that we invest in the types of companies that, quality, getting the quality aspect right in our portfolios means not just doing better on the downside, but getting better consistency over multiple market periods. And I think that's a discipline that, as advisors and allocators think about planning for downturns or building a new asset allocation for the period that we're about to go into, that's a critical takeaway. It's getting the quality aspect right. Quality is a way of investing in value.
Bill, I want to bring you in here. Obviously, as Westwood's small cap portfolio manager, you've got boots on the ground. You're the guy sort of feeling this as it comes. I wonder if you could talk a little bit about, sort of your investment philosophy, if it's changed, and also tell us a little bit more about how you target specifically this intersection of quality and value in small cap.
Sure, I'd be happy to. We think that it's very important to get the quality and value correct. We think if you just look at value, it could be a huge mistake in this market. There's other methods, or there's other things that are important, and that's why we've always looked for that intersection of quality and value. Basically, with the deep fundamental staff that we have, we can comb through the balance sheets of different companies. We can look at the earnings projections that we have, and you can't replicate that just by picking a factor, say value, and looking at that. So I think the deep fundamental understanding of the companies and the industries that they're in give us an advantage in this market.
That's a good point. With small cap specifically, obviously information is a little harder to come by, and I'm sure you've got to do a lot more digging. And on that, from your perspective, do you think the chances, of investors getting caught in value traps, we mentioned that earlier, do you think that's increased? Obviously, in our opinions, we think so. Love to get your take. And then secondly, is there a sector where you think investors may be more and more prone to this, or maybe they should exercise more caution, either for value trap or otherwise? Absolutely.
I think there's a real risk that value traps will multiply out there, and people will really get hurt by investing in those sectors. If you look at two sectors that are very traditional in the value space, energy and financials, both of those we think are in very difficult times at this point, given where the energy prices are, oil and natural gas specifically. And we think the companies have, in general, been over-leveraged over a number of years. In the 2014 to 16 timeframe, they were actually bailed out by the capital markets. That isn't going to happen this time around. And the banks are going to be very hesitant to lend to the oil patch. So we think that is going to be an area that screams traditional value that really isn't going to work in this environment. The other one would be financials. If you look at financials in this world of zero interest rates, it's very difficult for them to generate earnings. You've also going to have credit quality issues on the banking side, and those are just going to magnify as our unemployment rate ratchets up towards this 20% level. It'll be a very difficult period of time for the banks to navigate.
That's interesting. Bill, lastly, real quick, we talked about sectors you don't like. Can you give our viewers an overview of maybe sectors you're gravitating towards, and an example perhaps of how you might sidestep some of the carnage that we've seen play out in the space that you are looking at?
Sure, I'd be happy to. As we look in the environment that we're in now, a couple of the sectors that we've gravitated to are staples and healthcare. we've been finding great opportunities there. If you think about healthcare, for example, that's an area where over the past few years, it's been expensive. We know the quality companies in healthcare. There's been a lot of companies that we've looked at and that we've liked, but the valuation just wasn't there for those stocks. Now, with this market correction, those stocks are squarely in the intersection of quality and value, and we've been able to take advantage of that and add to our healthcare holdings. Similarly, in staples, another group that high quality companies, great balance sheets, great cash flow generation, but they've always screened relatively expensive to the market. And again, the market hasn't been that discriminatory on the downside. And these stocks have gotten to levels where they're great companies that we've liked for a period of time. And now they're squarely at that intersection of quality and value, and we've been able to take advantage of that.
Bill, thank you so much for your insight. And gentlemen, we're pressed for time here. I do want to close real quick with a question likely on the minds of viewers, and I'll pose this to Phil. I need your answer in about 10 to 15 seconds. How has Westwood's this small cap intersection theory proved out over time?
I think if you look at 5-year rolling periods, going back the last 5 years, we've had a batting average of about 100% in our small cap value strategy. The key takeaway is we've been able to outperform both in up markets, down markets, and relatively normalized market periods. And I think if you get the intersection right, which is what we're trying to do, you not only get the downside protection and outperformance in down markets, but you get a little bit better consistency over the long term with an allocation to this portfolio.
And thank you so much for joining me. I'm going to leave it there. We've got a lot more coming up in the series. Please stay tuned and stick with our channel. I'm Jared Levy. Thank you so much for joining us. Have a great day.